In my years of doing this, so something like a little over 50 years, what I found is that many times in my life, things that surprised me were because they never happened in my lifetime before, but they happened many times in history. So, for example, then studying these earlier times, if they happen mechanistically, I need to know how they work. So I studied the Great Depression. That's why we anticipated the 2008 financial crisis, because the same things happen over and over again, but sometimes not in our lifetimes. And so there are three big things that are happening to us that haven't happened in our lifetime. I like to measure things so I can see them in numbers and charts and so on. And those three big things are, first, the amount of debt and money creation, how much debt we have, the rate at which we are creating it, and then where we're getting that money from, the Federal Reserve and other central banks printing it. So that has never happened to this degree except for the 1930 to 45 period, which I studied before, and I needed to go back and study that in history. The second of those two things is the amount of internal conflict, populism of the left and the right, irreconcilable differences, with the largest wealth gaps that have existed. So the greatest political gaps, the greatest amount of populism, largest wealth gaps since you have to go back to the 1930 to 45 period, and actually it's larger than that, and you have to go back to 1900 to see that. By the way, if you want to see it, you'll see the charts in that. So we have a financial issue. We have an internal conflict issue that has very big implications for how well our country is run, but also what does it mean for taxes? What does it mean for the value of assets? I need to understand that. And the third was international conflict. So in my whole lifetime, the United States was clearly a dominant power, and we were in the American world order. 1945, the United States became the leading world power, counted for half world GDP. We had 80% of the world's money, because gold was money then, and we had a military monopoly. And so the reason that we were the world's power, that's why the United Nations is in New York, and IMF and World Bank are in Washington, so dominant. But we could see this conflict, this emerging competition. And the last time that happened was the 1930 to 45 period, and I need to study that. And so I studied that pattern, and these are the big things in our lives right now, but we are not acquainted with it. And so I needed to study the rise and declines of currencies, the rise and declines of empires. And because these cycles go on over a long period of time, I needed to see enough of those cases, so I had to go back, let's say, the 500 years. So I studied all of those. Now, I'm not an academic, I'm a practitioner. So it's not like I'm writing history books. It's for the purpose of making decisions today. So what I learned there has been important in our positioning in the markets right now. So it's just that practical. But those are the three big things. I also saw in history that there were two other things that were very important. One was acts of nature actually toppled more civilizations, killed more people than the others that I just mentioned. And they are droughts, floods, and pandemics. But like a pandemic, that's another one that comes along once in a lifetime and we don't see it. And then, of course, the most important force over a long period of time is man's adaptability and inventiveness. And now we have a greater ability. So, and that's the plus. You know, the others are challenging. So that's it in a nutshell. When I say these things, I use measures. There are 18 measures of health, and you can see them in the book. And they're measures of things like, what is your percentage of world GDP, what is your percentage of exports, how your reserve currency, but also what is your education level of education, what is your competitiveness, 18 measures of that. And we are in decline. We're declining on a relative basis, but even also some measures in an absolute basis. So that's what the arc is. And then China has been the leading competitor. I've been having, not since 1984, I've been going to China. Watch it, since I started going there, per capita income has increased by 26 times. And so if you use measures of comparability in military, technology, share of world GDP, all of that, you see that. That is the only real power. There are military powers, but history has shown if you're a military power and you're not an economic power, while you may be a threat, you're not going to win the war. So that's what the picture looks like. We can see it, right? We can see it in our various ways. If you give a lot of money and credit and you make it cheap enough, they will spend it. Okay, but when you create debt, it's stimulative over the short run and depressing over the long run. Because when you have to pay it back, then you have to earn more than you spend to pay it back. So what do you do with that debt? Okay, if you make it tough to pay it back, then what happens is you have an economic downturn. If you make it easy, you print the money. And that's the cycle. So when we look at what the Fed has done, the Fed and the government together gave an enormous amount of debt and credit and created a lurch forward, a giant lurch forward, and created a bubble, okay? And now they're putting on the brakes. Okay, so now we're going to create a giant lurch backward, I think, because it's simple. The amount of, we talk about inflation. Inflation is a very simple thing. It's the amount of money that's spent, money and credit spent, divided by the quantity sold is the price. And so if you take that money away, then you can't get rid of inflation. The way you get rid of inflation is to get people to spend less. And that is what an economic downturn. So the cycle goes like that, and then when you get to the point where, let's say, the economic pain is greater than the inflation pain, then you see them do the opposite. So we're going through that particular cycle. So it's, I think, a delusion to believe that, okay, what they're going to do is deal with inflation and it'll all go away because they'll deal with inflation by doing that without realizing what that means in terms of that, what that means of buying power. Think about the supply-demand of bonds, just to give you, we have to sell debt. Well, the government is going to borrow, central government is going to borrow about 5% of GDP, so they have to sell bonds in that amount. The Federal Reserve is going to sell, or have run off the balance sheet, about 5% of GDP. That's 10% of GDP. Okay, who's going to buy the bonds? Who's going to buy that? Oh, now they don't want to buy the bonds. We've had, pension funds, others, they don't want to buy that bonds. Foreigners don't want to buy the bonds. So then the way that works is interest rates have got to go up to a level that constricts private credit demand. And when that happens, then there's less spending. That's the mechanics. So there's that trade-off, and I think we're going to be in an environment in which they're trying to navigate these two difficult. You don't want too much inflation, and you don't want too weak an economy, and so they're trying to navigate that, which will be probably something like the 70s. And that's all happening in the context of the political conflict, which is very important, right, and the international conflict, because the international conflict has bearing on things like inflation, supply lines, and all of that. Now, the interest rates went from ridiculously stupid interest rates, and they're coming into an area that still, I think, is too low, but it's not as ridiculous as it was before.